Visa just posted a flawless $4 trillion quarter.
Yeah.
By all accounts, I mean, an absolute fortress of a print. They delivered $11.6 billion in net revenue, hitting 14% growth, and they pushed more volume through their network in a single quarter than ever before in the company's history.
Right.
So if you are looking at those headline numbers, you might assume everything's perfectly calibrated. But if everything is so perfect, why is their executive team dodging direct questions on margins, deleting their own forward guidance frameworks, and quietly scrubbing major tech initiatives from the public record? Today, we are putting Visa's fiscal Q3 2026 earnings call under a microscope.
It is a necessary exercise, frankly, because headline beats of this magnitude almost always serve as institutional camouflage. A $4 trillion volume quarter gives executive management the cover they need to quietly retire old promises and, shield new strategic pivots from analyst scrutiny. When the top-line revenue is that strong, it temporarily neutralizes the standard critical frameworks that analysts usually apply.
Right. The results are simply deemed good enough.
Exactly. Good enough to avoid the hard questions.
Which is exactly why we are taking a strictly clinical approach to this deep dive.
Yeah.
If you are tracking Visa's stock right now, look, we are not here to celebrate the headline beat. We are here to audit the gap.
The gap. Right.
We are going to isolate the exact divergence between the forward guidance architecture management outlined back in April during their Q2 call and the actual structural deliveries they confirmed in July. We are auditing the shifting timelines of their emerging tech stack, the strategic deletion of certain narratives, and their defensive posture when cornered on margins.
To do that effectively, we have to start by looking at what actually survived the quarter. We need to analyze the specific areas where management successfully migrated their narrative from prospective promises to longitudinal structural facts.
The hardened data.
Correct. And the clearest example of this hardening process is their value-added services, or VAS. For context, VAS encompasses their issuing, acceptance, risk and security, and advisory products.
So let's trace how that narrative shifted. In April, CEO Ryan McInerney was pitching VAS heavily as a massive opportunity. He noted it represented roughly 30% of their net revenue and was growing at 25+%.
Right.
But the framing was highly confident yet still prospective. He framed it as a future liver, something being continually strengthened with AI.
That is a critical distinction to make. In April, analysts were repeatedly probing management on this. They wanted to know whether the sudden strength in VAS was merely a cyclical, event-driven anomaly, a temporary spike in consulting or risk services, or if it had real underlying durability.
Yeah.
Management's response in Q2 was encouraging, but it lacked a rigid architectural defense. They just didn't have the data to prove it wasn't a fluke.
But by July, CFO Chris Su completely altered the measurement framework.
He did.
He didn't just report that VAS hit 34% year-over-year constant dollar growth, reaching $3.8 billion. He delivered a longitudinal data set to essentially shut the analysts down.
He noted that all 4 of those VAS portfolios individually grew over 20% year-over-year for a full 12 months straight, with the advisory segment accelerating the fastest.
The deliberate nature of that analytical move is exactly what we look for. By stating that these portfolios grew faster over a 12-month window than their historical Investor Day growth rates, management successfully reforged a cyclical question into a structural reality.
Yeah.
They essentially said, look, this isn't a temporary spike. This is the new normal engine of our business. They invited longitudinal scrutiny because they knew the data could support it. They effectively positioned VAS as a hardened, functioning growth engine that is permanently carrying its own weight on the P&L.
Agreed. So they successfully defended their value-added services. But they couldn't use that same offensive strategy for their commercial and money movement segment, or CMS.
No, they couldn't. This is where we see what I would characterize as a highly orchestrated, controlled burn of expectations. Let's rewind to April. Visa posts a massive 24% constant dollar growth in CMS. But Su flags, entirely unprompted, I might add, that this outperformance contained non-recurring performance adjustments and favorable deal timing.
Right.
He practically warned the market that the numbers were artificially elevated.
It is a highly unusual tactic in modern investor relations to preemptively de-risk a strong print before an analyst even asks the question. Think of a controlled burn in forestry. Visa knew they had a fantastic Q2 overall, so they used that massive revenue headline as a firebreak.
Right, they dumped the bad news right then.
Exactly. They dumped the impending slowdown in commercial growth right in the middle of a great quarter, knowing the overarching positivity would safely absorb the flames. When Jason Kupferberg from Wells Fargo pressed Sue on it during the Q2 Q&A, Sue firmly locked in that disclosure.
Which brings us to the cause and effect of the July print. In Q3, CMS organic revenue growth stepped down significantly, dropping to 17%. Sue explicitly acknowledged this was due to lapping those exact pricing impacts and the absence of the Q2 adjustments.
The control burn was executed flawlessly, and it worked because the underlying organic story was strong enough to absorb the hit. Even with the revenue stepping down to 17%, commercial payments volume actually accelerated by 2 points, hitting 13%.
Yeah.
The organic momentum of the segment absorbed the lapse of the one-time tailwind. For an institutional investor, this is exactly what you want to see. It validates management's forecasting mechanics and builds profound institutional trust.
We saw similar maturation in how they handled their European expansion narrative. Look, it's one thing to tell investors you have a theoretical pipeline, right? It's another to prove it.
Right.
In April, management floated an aggregate aspiration. They claimed they had roughly 30 million new credentials coming from pipeline wins in Europe. It was forward-looking, but highly theoretical.
Very theoretical.
But by July, they grounded that entirely. They anchored it to a specific reality by announcing the conversion of the NatWest Consumer Credit Retail Bank portfolio.
Migrating a metric from a vague geographic pipeline to a named Tier 1 institutional partner is the textbook definition of narrative maturation. It proves the April projection wasn't just spreadsheet modeling. It had actual commercial weight behind it.
Correct. But this is where the audit takes a turn. While Visa's legacy metrics like VAS, commercial volumes, and European credit conversions are robust and highly transparent, management's handling of emerging technology reveals a very deliberate retreat.
Yeah, a stark contrast.
When we shift from their established payment rails to their frontier adoption curves, that structural conviction suddenly vanishes.
We see this most aggressively in how they handle reprioritized timelines. Let's examine agentic commerce. To understand the pivot, we first need to define the mechanism. Agentic commerce refers to AI agents autonomously conducting transactions on behalf of users. For example, your AI assistant negotiates a micro-contract with a vendor's AI for a software subscription, and Visa sits in the middle, acting as the transaction rail.
Yep.
In Q2, management treated this as a load-bearing architectural pillar for their future growth.
Right. In April, CEO Ryan McInerney pitched a very rigid, specific 4-part framework to monetize this.
Yeah.
He laid out transaction multiplication, B2B automation, GDP growth acceleration, and broad digitization.
Yeah.
It was a structural thesis with internal logic and mechanism design.
Exactly.
If you are an analyst building a financial model, that 4-part framework gives you a very specific set of checkpoints to track adoption. But fast forward to July, and that entire 4-part architecture was completely abandoned.
It was entirely scrapped from the script. In its place, management pivoted to a list of operational milestones. They talked about shipping the agent score, the agent directory, the token assurance framework, and their OpenAI partnership. The tone completely shifted from structural mechanism design to simply listing shipped product features.
Wait, I have to stop and push back on management's intent here. In April, they gave us a strict roadmap for AI commerce. Now they're just handing us a list of software updates.
Yeah.
Replacing a defined structural framework with a punch list of shipped products is a classic convenience pivot. It quietly removes all the commitment checkpoints. If a company just lists products, analysts cannot accurately model the total addressable market expansion. You simply can't hold management accountable to an adoption timeline if the measurement framework no longer exists.
That is the exact mechanism of a convenience pivot. You throw away the measuring stick so the market can't grade your progress. And if you parse McInerney's phrasing during the July Q&A, the intent becomes obvious. Harshita Rawat from Bernstein pressed him specifically on the market expansion opportunity for AI agents. McInerney's response was highly calibrated. He stated that agentic commerce is a when, not an if, but immediately added that the timing is tough to predict.
So he is introducing timeline uncertainty where just 3 months prior, there was absolute structural confidence.
Correct. In April, they projected an air of inevitable near-term catalyst momentum. In July, by emphasizing that the timing is difficult to predict, They are executing a calculated modulation. They are maintaining theoretical confidence in the eventual outcome while entirely stripping away their own accountability for the actual adoption curve.
Which naturally brings us to the phenomena of narrative inertia,
Mhm.
specifically regarding their stablecoin positioning.
Right.
For you listening, we define narrative inertia as management anchoring to a high-conviction, hard mathematical metric in one quarter, and then relying on the lingering momentum of that announcement to obscure the fact that the metric has completely stalled out in the next.
The stablecoin metrics provide a pristine case study of this tactic. In April, McInerney delivered a highly specific anchor metric. He cited a stablecoin settlement run rate of $7 billion annually, growing at over 50% quarter over quarter.
Right.
He also named specific roles Visa was playing, such as acting as a validator on Tempo and the Canton network.
And look, if you are compounding a $7 billion run rate at 50% quarter over quarter, you are implying massive exponential scale by Q3. But in July, that $7 billion anchor metric vanished.
Complete.
The 50% growth rate was completely scrubbed. Instead of updating the core economic driver, they replaced the math with a layered product monologue about the Visa stablecoin platform and their OpenUSD partnership. They swapped out hard economic data for infrastructure vocabulary.
And when Jeff Cantwell from Seaport Research directly challenged McInerney on OpenUSD's competitive positioning against giants like Circle and Tether, McInerney deployed a highly disciplined evasion. He simply stated, "Our role is not to pick winners."
Which, on the surface, sounds appropriately agnostic for a network provider. You provide the rails, you don't pick the trains.
It sounds agnostic, but strategically, it is a deliberate tactic to obscure reality. By refusing to engage with the competitive dynamics of Circle versus Tether, management avoids discussing where Visa's actual economics will settle once market share consolidates in the stablecoin space.
Yeah.
The $7 billion run rate was the only metric proving they were actively capturing value. Its omission in Q3 suggests the underlying volume is likely not scaling as linearly as that April narrative implied. The math broke, so they stopped talking about the math.
Exactly. And while the stablecoin metrics were merely obscured with new product jargon, other high-priority strategic initiatives from last quarter didn't even get that courtesy. They were entirely evaporated from the public record.
This is where audit requires us to flag explicit omissions. We are tracking evaporated narratives.
The most glaring of these is the Visa Command Line Interface, or CLI. Let's unpack what a CLI actually represents for a network like Visa. In software engineering, a command line interface allows a developer to interact directly with the system using lines of code, bypassing the graphical interface entirely. In April, Visa explicitly pitched the CLI as a near-term activation that would enable microtransaction commerce at scale.
Yeah.
The idea was that developers could code their AI agents to seamlessly ping Visa's network for fractions of a cent. Management talked about promulgating standards and pricing for it. They highlighted positive early developer feedback. It was framed as the vanguard of their entire agentic commerce strategy.
And in the July transcript, there is absolute undeniable silence regarding the CLI. It is never mentioned once.
So I have a skeptical question for you on this. Does the total evaporation of a flagship proof of concept signal that the CLI was a functional failure internally? Or is it more likely that it was just quietly absorbed into their internal tech restructuring without a formal disclosure?
If we connect this to the mechanics of how enterprise product cycles operate, the language they use in April is the key. They committed to promulgating standards, products, rules, and pricing. You do not use that specific operational vocabulary for a conceptual brainstorm. That language indicates a near-term roadmap item with capital already allocated to it. Its sudden disappearance is a stark, negative data point.
Yeah.
It strongly implies a failure in management's forecasting accuracy regarding the immediate viability of microtransactions on their network. If it had succeeded or even hit its internal benchmarks, they would have updated the metrics. Silence means it's stalled.
We see a similar, though slightly less absolute, evaporation in how they discussed Visa Direct and their recent Pismo acquisition. In April, the updates were highly granular. They named UnionPay International. They named X-Money. For Pismo, they specifically highlighted Q2 signings in France, the Philippines, Paraguay, Romania, and a massive anchor deal with Wells Fargo.
The April update provided analysts with the exact geographic and institutional coordinates required to model the infrastructure expansion. You knew exactly who they were partnering with and where.
Contrast that exactness with July. The momentum is theoretically still there, but the granularity is entirely gone. Visa direct transaction volume grew 21%, but they dropped the 18 billion endpoints metric they were touting just months prior.
Right.
Their primary use case example was a DoorDash product integration, which is fine, but hardly a structural equivalent to the Union Pay scale. And for Pismo, they claimed expansion from 15 to 19 markets, but they flatly refused to name a single country or a single Tier 1 bank. It is aggregate vagueness.
When management shifts from naming specific Tier 1 banking partners to citing aggregate market counts without names, they're managing expectations downwards. Going from 15 to 19 markets doesn't help an analyst build a revenue model if you don't know whether those markets are the UK and Japan or tiny developing nations.
Exactly.
The growth is continuing, but the quality or scale of the individual deals likely does not match the Wells Fargo anchor from the previous quarter. They are coasting on the narrative momentum of Q2 while providing a definitively lower caliber of data in Q3.
Which leads us to how management behaves when analysts actually try to corner them on these shifting metrics. Evaporating narratives require defensive tactics, particularly during the Q&A segment, to run out the clock on analyst scrutiny. The most aggressive defensive posture we saw in July surrounded their workforce reduction and the resulting margin opacity.
This was the surprise disclosure of Q3. Visa announced a $563 million severance package for role eliminations, predominantly in the technology and product divisions.
Right.
Management framed this massive CapEx shift as a move toward what they called agentic squads of 2 to 4.
They cited internal operating metrics to justify this restructuring, claiming they are seeing 80% more code commits and 65% faster feature development from these new agentic teams. But let's be clinical here. There is absolutely no prior quarter baseline provided to verify these claims.
None.
It is an internal operating metric completely shielded from external audit. We just have to take their word for it.
It is a closed-loop claim. But the more pressing issue for institutional models is the margin ambiguity. Sanjay Sakrani from KBW asked a direct, necessary question regarding that $563 million severance. He asked, will these savings be fully reinvested into the business, or will a specific proportion drop to the bottom line for margin expansion?
And McInerney completely stonewalled him. He just listed a portfolio of reinvestment priorities and relied on their historical track record. CFO Chris Su followed up with a vague assurance that they will continue to deliver strong margins into the future.
Right.
Look, in institutional communications, offering a qualitative adjective like strong in response to a direct mathematical question about margin splits is a classic defensive tactic to maintain opacity. I mean, strong is the exact qualitative adjective you use when you absolutely refuse to be held to a math problem next quarter.
Precisely. It allows them to retain maximum capital allocation flexibility without committing to a quarterly margin target that analysts can grade them against. This pattern of deflection was present throughout the entire Q&A session. Consider the evasion regarding the FIFA World Cup.
Right. Will Nance from Goldman Sachs asked for a straight quantification. What was the aggregate boost to cross-border travel from the World Cup?
Su confirmed it aided inbound travel to North and Latin America, but explicitly declined to quantify the benefit. The underlying logic here is transparent.
Yeah.
If Su provides the exact basis point benefit of the World Cup, he simultaneously provides analysts with the exact near-term reversal headwind Visa will face when they lap the event next year. Sidestepping the number entirely protects next year's comparables.
We saw an even softer deflection from McInerney when Harshita Rawat pushed him on the actual economics of agent-to-agent transactions. She was asking for the specific mechanical extraction of value. How does Visa actually make money in a fully automated B2B flow?
Right.
Instead of answering the economic question, McInerney retreated to historical fluff. He spent his time summarizing the trajectory of e-commerce and tokenization, using past successes to distract from the fact that they clearly have not yet finalized the economic mechanics for autonomous agents.
It is a sophisticated pivot. You validate the analyst's premise by comparing it to massive historical successes, but you provide zero forward-looking mathematical substance. We also noted the complete disappearance of the European competitive threat. In April, management gave a very frank admission regarding rising payments nationalism in Europe, explicitly acknowledging local schemes like Wero and the digital euro as threats to their market share.
And in July, total silence on the macro threat. McInerney replaced that frank risk assessment entirely with a localized, wins-focused monologue about product breadth. It is a calculated deletion of a risk factor from the narrative record.
Which raises an important point about how they choose to utilize repetition. While they deleted the European risk, they retained exact word-for-word repetition on their consumer health outlook.
That stood out immediately during the read-through. Quote, "We do not see signs of the lower spend consumer weakening." End quote.
Yeah.
They repeated that phrase verbatim from Q2 to Q3. Let me ask you, when a management team at this level uses exact repetition across quarters, is that a signal of ironclad structural conviction in their macro data, or is it a highly rehearsed legal defensive posture to avoid making new forward-looking statements?
It functions as both, but the July transcript reveals it leans heavily toward conviction in this specific instance.
How so?
The reason is that in July, they finally anchored that rehearsed language to a definitive historical metric. They announced that U.S. payments volume grew 10% year over year, a rate not seen since fiscal 2019 if you exclude the COVID recovery anomaly. Providing that 10% volume metric transformed a repetitive defensive statement into an offensive validation of underlying consumer health.
Right. So, synthesizing this audit for you, the listener, Visa's Q3 was a masterclass in utilizing aggregate financial strength to obscure structural pivots. Visa is essentially using a booming legacy business to hide the fact that they haven't entirely figured out how to monetize the future.
Exactly.
Management successfully hardened their identity as a global hyperscaler. They proved the longitudinal durability of their value-added services, shutting down the fluke argument. But simultaneously, they engaged in significant narrative inertia regarding stablecoins, quietly evaporated the Visa CLI microtransaction thesis, and deployed heavy defensive tactics to obscure the shifting timelines and margin impacts of their internal restructuring.
The core business is compounding predictably, yes, but the emerging technology stack is being aggressively shielded from strict accountability.
Which leaves us with one final, unresolved data point for you to model on your own. It is perhaps the most glaring omission in the entire transcript. For 2 consecutive quarters, Fahed Kunwar from Rothschild has asked management a very simple question. Do they plan to recalibrate their Investor Day revenue algorithm of 9 to 11%, given that they have materially exceeded it for 2 solid years?
Right.
And for 2 consecutive quarters, management has flatly refused to answer.
A refusal to upgrade guidance when outperforming structural estimates is the loudest silence on an earnings call.
Agreed. So the question that remains is this. What does management's stubborn refusal to officially upgrade their own algorithm, despite printing a flawless $4 trillion volume quarter truly signal about their internal, unstated macroeconomic fears for fiscal 2027? They are building the scaffolding for a record year, but they are clearly preparing for a storm they refuse to name.